Before you celebrate the sale of your business, make sure you understand what portion you're going to keep and what portion will go to the IRS. That's exactly what my today's guest will help us understand. Welcome to Business Beyond You, the one-stop hub for insights, conversations, and perspectives business owners need to build businesses that last beyond them. I'm Sara Vaziri, an M&A advisor in the state of California, and today I have with me Rex Ours, who is a CPA with years of experience helping business owners, and he will help us understand the tax implication of selling a business. Rex, welcome to Business Beyond You.
Thank you, Sarah. Thank you for having me.
Sure. So, as you know, I'm an M&A advisor and sell businesses, but not always. So when we get involved in a business sell, we always suggest the sellers to get in touch with a CPA who is specialized in taxes from the beginning, if they haven't done it before. So they get ready for that time. But let's assume, for the sake of conversation, that we have a seller who haven't worked with anybody and now they have sold their business. And after they get their money is the time that they go to a CPA and they want to file for the taxes related to the sale of their business. I want you to help us understand exactly what happens at that time, what steps they have to go through, and how do you go about filing their taxes and how much they approximately have to pay. It would be great if you can give us some understanding about that.
Great. Well, obviously, if the transaction has been completed, we now are at the mercy of how that transaction was completed. And what I mean by that is were you able to sell your stock, or did the buyer not want to buy your stock but wanted to buy assets from you, such as inventory or AR and fixed asset, machinery and equipment, whatever your business line is? Those two things are going to really drive the tax bus at this point, because it's a closed transaction. If you're a corporation and you were fortunate enough to sell your stock, well, then that's pretty much on the lines as if you sold some IBM stock that you bought 10 years ago. Whatever you paid for that stock, whatever money you contributed into the corporation to start the company, that's your basis in a C corporation stock. And if you sell a C corporation stock, your tax calculation is pretty straightforward. Your sales price minus what you paid for the stock gets you the gain, and now you pay tax on it. If you happen to be an S corp and you sell stock, it's pretty much the same. You're pretty much in the same boat. Your basis may be a little bit different because you're an S corp, but the process is pretty much the same. Now, if you sell assets, that's where the challenge really comes in, because if you're a C corporation and they didn't want your stock, but you really had to sell for whatever compelling reason, you've now sold assets inside a C corporation. And most of you, hopefully in the marketplace, have heard that C corporations generate double taxation. And that's really going to give us a challenge, if that's the case, to help you minimize that tax impact of the double taxation. If you sell your assets and you're a sole proprietor or you're a single member LLC, that's really, now it comes down to allocating that purchase price. And maybe your transaction agreement explained that, maybe it didn't. So that has an impact. But the goal here would be to make sure that we allocate as much of that purchase price if they bought your assets and you're a sole proprietor or a C corporate or an S corporation. Make sure that the majority of that goes to goodwill, customer list, those kinds of intangible assets. That's where we can save you the most tax after the fact.
Which, as far as I understand, the buyer and seller need to agree on how they will report it to IRS, because they need to report it the same way. So one thing we make sure it happens always before close of escrow is to agree on those. But if they haven't done that, then you have another problem there, correct?
You're absolutely correct. Code Section 1060 requires that both the buyer and the seller report a transaction on their tax returns in the year of the sale. And those two reports are meant to match. And if they don't match, then the IRS has reason to want to come look at the transaction because there's obviously a disagreement and somebody may be improperly reporting the transaction. And that's when the IRS gets real curious.
Got it. So to understand, like some people, they don't have any idea that, let's say I sell a business at $5 million. What is the range of taxes that we are talking about? Can you give,
Well,
I know there, it depends to so many things, but just to have an idea, what is that range we are talking about?
pretty straightforward. I mean, and we talk about this a lot in our webinars and helping taxpayers understand that if you're able to sell your stock, if you have a stock transaction, 99.9% of the time it's you've held that stock for more than a year. So that gets you what we call long-term capital gain treatment on whatever that gain is on the sale. And that puts you in the most favorable tax bracket there is, and that's the 20% bracket, possibly 15%, depending upon what else is going on in your return and the size of the transaction. But let's just say, for argument's sake, put you at the 20% tax bracket. Now, contrast that with ordinary tax rates that can be as high as 37%.
Mhm.
So, sale of the stock is really an important piece. If you can do that, you're going to have the most favorable tax brackets.
Okay, okay. So now let's go back to putting a good foundation. So when the sales ends, you can, the seller can have done everything they could to minimize this tax consequence. First of all, how long before they even get to the process of selling their business, they need to think about this stuff and start doing things about it?
Great question. Um, most buyer or most sellers, when we say 5 years, they go 5 years. I gotta be thinking about this 5 years before I do it. And the answer is you should be, and you most definitely need to be if you are a C corporation.
Mhm.
Because if you are a C corporation and you stay a C corporation, you face double taxation. If you're a C corporation and make an election under subchapter S of the Internal Revenue Code to be taxed as a pass through as a subchapter S corporation, then 5 years from that date, you can sell the assets of the business and not experience any double taxation.
Mm. So even if the company has been C Corp for a long, long time, still there are things they can do to change it to a score for the time that they want to sell.
But you need that 5 year window.
Okay.
Okay. Now, if you're already a C corp and you're thinking, I might sell in 3 years or 4 years, it's still the right time to start. There's things that a seller can do. I like to call it getting your house in order. There's a lot of things that you can do, not only documentation wise, but operational wise, that will make you profitable during the time you're preparing for the sale and give you more cash left over after the sale. So
Mhm.
that's why having a good time frame in front of the sale is very important. And one of the key elements there is an element called working capital. If you're an ongoing business and it takes you three, four, five, $600,000 a month every month to run that business, okay, a buyer's going to want that same amount of money in the business when he takes it over. Okay, so the key here is 600,000 the real number that you should be running the business on, or if you become efficient, can you run that business on 400,000 a month? thereby dropping 200,000 to the owner's pocket because the buyer is only going to ask for working capital equal to the trailing 12 months. And if
Hmm.
your trailing 12 months says 600, but then you try to convince them, oh, no, no, it only takes 400, they're not going to believe you because you haven't proved it in your actions. But if you prove it in your actions, and that takes time, improving cash flow and working capital turnover and everything like that takes time. It's not a 1 month, 3 month venture. It's a 12, 18, 24 months to really groom a business and get it as efficient as possible. But that could mean a couple 100,000 more in the pocket of the owner without ever changing the purchase price.
Yes. I have so many examples of what you said. Like the seller comes to me and say, yeah, the minute I get these invoices, I pay them. I don't like to keep invoices. Sorry. Things like that. You have really done something against yourself. Or I had a seller who was really, really well. He said, yeah, I have so much cash, so I don't even go after my invoices. I just send them and stay until they pay them like 6 a.m. Then now that I want to sell your business, the buyer looks at it and how should I prove to them that if they come in and go after invoices right after they send them, they won't lose that buyer? So what you said is amazing. Yeah, we need somebody like you guys to start working with the sellers before the come go to the details of these kind of things and set the stage for that 12 trailing months. So when the buyer look at the business, we don't see these kind of problems.
Yeah, there's and that's just one example. You can go to and it takes the same amount of time, a couple of years, but you can look at your revenue stream. Do you have 3 or 4 big clients and then 8 or 10 that are little teeny clients, or do you have 2 big clients and the rest? What does your revenue diversification look like? Because that has a huge impact on the value of the business once you sell. Well, you can't change that in 90 days. You
Correct.
need 2, 3, 4 years. So that's important from that perspective. The other piece is it takes time to find the right business advisor who can help you sell your business. Okay. It's not just, anyone is perfect for you. Just pick one. Now, that's not the case. It's like anything. It becomes a relationship. You need to understand strategy and thought process. So you're going to want some time to get to know your advisors and make
Yep.
sure that you're working in together to really maximize the transaction. And here's the biggest point that most business owners don't understand. Let's say they come to you and they say, okay, we're ready to market the business. Go through the process, get us in the marketplace, find us some buyers. From the moment that process starts and you start building the sim and all of the other things, you as a business owner now have 2 jobs. You got to keep running your business because no deal is a done deal until it's paid for. And you got to work the transaction, support Sara, support questions from buyers, answer all of those things, be in meetings, analyze data. You have 2 jobs. And the more of that work you can do in the first year, 2 or 3 before you go to market, the better the process will be once you're at that point. And
Hmm.
I've had so many business owners over the years said, I never realized how much work it was to sell a business.
Yep. Especially if the business is dependent to you so much, and like I was working with a business owner and every time we needed information, he had to prepare it himself. That doesn't work when you want to sell the business. That's why you need to bring advisors long before we start the process. So when we need we talk to so many buyers, we make competition and we say that, okay, you have this deadline to give us offer or whatever. And then suddenly they ask for information and it takes forever for the seller to sell. I was telling actually to one of my sellers that it's like we are in the field playing a game together and I am waiting for you to pass me the ball and that ball never comes. So how can we win? It doesn't happen.
Yeah, that's a really good analogy, and there is a lot of things that in that year two, three run up to actually transacting a business sale, there's a lot of things that can be documented, analyzed. The goal is for the owner to use the advisors as a what I want to say a analytic eye looking at them and saying, here's all the weaknesses of your business. Now let's figure out how we can address at least the questions as to why. And if not, make changes that will improve the situation before we go to market. There's so much it can be done there. And, because even if you can't change it, you want to know that you have the correct answer and it's an answer that can be substantiated. Unsubstantiated answers kill deals. So the more of that work that can be done leading up to the process, the better the transaction's going to be.
Rex, thank you so much. We are running out of time, but it was great to have you here. I am sure that we will talk more. There are so many subjects that we can cover, on what kind of strategies are there to, lower those taxes and all of this stuff. We will hopefully have you back or one of your colleagues to go over those subjects also. But thank you so much for being here. Please give us your contact information if somebody wants to get your help to prepare their business for the sale. How can they reach out to you?
Well, as you can see on the screen here, MKW, that's our firm, Milo Connect and Warner. So mkw.com or weaddvalue.com is our email or website address. And you can reach us through the website. And you can just email me at rexhours@weaddvalue.com. And happy to answer any questions that you may have. And I appreciate you having me on today.
Thank you so much. Bye.